You did the research. Institutions arrived. Bitcoin should be soaring. So why does it feel trapped? In this video, we uncover the hidden forces shaping the price. Subscribe to Leo, Lazy Investor, to understand what most investors miss. There's a specific kind of frustration that long-term investors know all too well. You commit to an asset after careful research, strong conviction, and overwhelming positive news, yet the price refuses to behave logically. Many Bitcoin holders expected institutional adoption to act like rocket fuel. ETFs launched, large funds entered, and corporate treasuries expanded exposure. Instead of explosive growth, the market delivered stagnation, sharp pullbacks, and emotional whiplash. This disconnect leaves investors questioning their judgment. If adoption is real and scarcity is mathematical, why doesn't the price reflect it? The answer may have little to do with Bitcoin itself and everything to do with financial structures surrounding it. History shows that when an asset threatens existing power systems, resistance rarely appears as outright bans or obvious attacks. Instead, pressure is applied quietly through leverage, incentives, and time. These mechanisms don't require illegal activity or secret coordination. They operate within the rules, exploiting human psychology. Fear, impatience, and uncertainty do the heavy lifting. When investors feel trapped between belief and doubt, they make suboptimal decisions. Understanding this dynamic reframes the entire situation. The issue isn't that Bitcoin stopped working. It's that modern financial systems are extremely effective at creating stress without breaking laws, and stress changes behavior. To see how this works, it helps to look beyond crypto and into financial history. Entire countries have fallen into similar traps. Governments borrowed heavily in currencies they couldn't control, assuming future growth would solve everything. When interest rates rose and economic conditions tightened, those debts became unbearable. Assets were sold, sovereignty was weakened, and wealth quietly transferred. This process is known as a debt spiral. The most dangerous part isn't the numbers, it's the psychology. Once obligations feel overwhelming, decisions stop being strategic and start being defensive. The same principle applies to corporations. A company holding valuable assets but burdened by fixed financial obligations becomes vulnerable to pressure. Markets sense that vulnerability immediately. All it takes is a shift in sentiment to trigger cascading effects. No rules need to be broken. No explicit manipulation is required. The structure itself does the work. Investors watching from the outside see only price movement. Those who understand the mechanics see a countdown clock. As time passes, pressure increases, and when pressure peaks, forced selling often follows. Forced selling almost never happens at favorable prices. This pattern has repeated across decades, industries, and asset classes. Once you recognize it, today's market behavior stops looking random and starts looking familiar. In Bitcoin's case, the difference between owning the asset directly and holding exposure through leveraged corporate structures is critical. Some companies built strategies centered entirely on Bitcoin, funding purchases through debt and financial instruments. When prices rise, leverage looks brilliant. But when markets stall or pull back, leverage becomes a liability. Interest payments don't pause for market sentiment. Dividends don't wait for price recoveries. Cash reserves shrink regardless of belief. At that point, Bitcoin is no longer just a long-term conviction. It becomes a potential source of liquidity. Markets price this risk aggressively. Stock prices fall, not because Bitcoin failed, but because the structure surrounding it looks fragile. Once
Once valuations drop below underlying asset value, fear accelerates. Investors worry about dilution. They worry about forced sales. They worry about domino effects. None of this requires misconduct. It's simply how incentives collide under stress. The result is amplified volatility and widespread confusion. Observers mistake structural weakness for asset weakness, but those are not the same thing. Bitcoin's fundamentals can remain intact while pressure builds elsewhere. Understanding that distinction is essential for navigating periods where price action feels disconnected from reality.
This is where incentive alignment becomes crucial. Institutional investors don't think like retail traders. They don't panic at volatility. They analyze it. If pressure creates the possibility of acquiring a scarce asset at a discount, that pressure becomes attractive. The goal isn't necessarily collapse, it's discomfort. Prolong uncertainty long enough, and weaker hands exit voluntarily. Larger players accumulate quietly. This strategy has appeared in gold markets, commodity cycles, and equity markets tied to leverage. The narrative is always similar: too risky, unsustainable, structurally flawed. Sometimes those warnings are valid. Sometimes they're exaggerated. Either way, the psychological impact is powerful. Bitcoin's decentralized nature makes direct control impossible, so influence shifts to the surrounding ecosystem: stocks, debt, derivatives, expectations. That's where pressure is applied. Assets without value don't receive complex strategies. They're ignored. Sophisticated pressure is reserved for assets worth owning, but not at full price. Once you see it that way, volatility stops feeling random. It starts to look intentional, not in a conspiratorial sense, but in an incentive-driven one.
The real question isn't whether Bitcoin is broken, but who is under pressure and why. Experienced investors separate asset fundamentals from structural stress. When prices fall without fundamental deterioration, something mechanical is happening. That doesn't eliminate risk, it clarifies it. For long-term holders, this understanding changes behavior completely. Instead of reacting emotionally, they observe positioning. Instead of watching charts alone, they study incentives. Financial education becomes the strongest defense against psychological pressure at scale. Markets don't reward emotional precision, they reward patience and clarity. Bitcoin remains volatile, controversial, and uncomfortable by design. That volatility invites strategies designed to test conviction. History consistently shows that wealth transfers occur when fear overwhelms understanding. Recognizing old patterns in new markets is a skill few develop. Those who do gain a lasting edge. Not every period of silence or decline signals weakness. Sometimes it signals accumulation happening quietly, out of sight. And in markets, what happens quietly often matters most.
If this perspective helped you think more clearly, subscribe to XYZ, share your thoughts below, and keep learning. Understanding the game matters more than reacting to every move.